Mortgage rates just dropped below 6% for the first time in over 2 years. So, why does it feel like the housing market isn't reacting? That's what we're going to break down today, because the headlines sound great, but the story underneath is what actually matters. Let's start with what everyone's seeing. Rates are down, affordability is improving, and historically, that should bring buyers back into the market. Lower monthly payments make homes more accessible, so naturally, you'd expect demand to spike. But that's not happening. Here's what most people are missing. Mortgage rates don't just drop randomly. They're tied to the bond market. And right now, investors are moving money into bonds. Why? Because there's uncertainty in the economy. When that happens, bond demand goes up, yields go down, and mortgage rates follow. So yes, rates are dropping. But they're dropping for a reason that actually makes people more cautious. And this is where the disconnect happens. You have improving conditions on paper, but declining confidence in reality. So buyers pause, they wait, and they second guess. Even if they can afford more, they're not sure if they should act. So what does this create? It creates a market with less competition, more inventory, more negotiability. And that's something we haven't seen much of over the last few years. This is what I call a friction market, where everything is starting to move in the right direction, but not all at once. And historically, these are some of the best environments for investors, because when confidence is low, pricing becomes less efficient. Deals get better, terms get better, sellers become more flexible, and if you're looking at the alternative asset class like short-term rentals or boutique hospitality, this becomes even more interesting, because travel behavior shifts differently than home buying behavior. People may hesitate to buy, but they still travel, and they travel closer and more intentionally. So yes, mortgage rates dropping below 6% is a big deal, but the bigger takeaway is this. It's not just where rates are, it's why they're there. And if you understand that, you're not just reacting to the market, you're positioning yourself ahead of it.